Thank you, everyone, for joining us today. I am Joan Hull, the Director of Relationship Management for CanAm Enterprises, and I am here with the renowned value investor, Rupal Bhansali. Rupal, I am so excited to be here with you and to hear your thoughts on managing risk and volatility in today's crazy world.
Thank you for having me.
So let's just dig right in. We have a lot to cover. I was going to start with your bio, but it is so comprehensive and it has spanned so many decades and you've done so much. I wanted to actually let you do that, please, and just start off with telling us from the beginning, how did you get started in investing? What drew you to it?
Well, Joan, I was actually born in a family of brokers and bankers. So in
Oh,
some
well,
ways, it is in my DNA and destiny. But there's actually a backstory that I'd like to share, which really sparked my interest in investing. I was born in the 60s, and my dad was a stockbroker back in the day. And he had his family business, doing broking for his clients. And stock markets were booming. He put me in a private school. He gave me everything I wanted. It was a good life. And then the 70s came along and, stock markets crashed and so did our family fortunes because we had not invested wisely. It came home, and it was very personal for me because I remember as a child, one day I went to my mom and I wanted to get this backpack, which all the cool kids in the classroom had. And she told me, sure, when we have money. And I'm this 9-year-old thinking, what is this mysterious thing called money and why don't we have it? And so that kicked off a cycle of really learning money, earning money, and ultimately managing it. Because I didn't want anybody to experience later in life what I had experienced early in my life, which is getting used to a standard of living and then having a big reset downwards on it. They say being poor is the worst thing in the world. I disagree. Try being poor after you've been rich. You know what you're missing. So anyway, that's sort of what kicked off my interest in investing, and that's how and why I became the investor that I am today.
Wonderful. And you've had such an amazing career, and we can talk about that throughout this conversation and draw on all of the experiences that you've had. But I wanted to start off with another important question. You talk about reducing risk to enhance returns. That statement sounds contradictory. How can you lower risk and still enhance returns?
In fact, it's the opposite. You cannot enhance returns without reducing risk. People don't realize that. And, hence my articulating it at every forum that I can get, because people think investing is about making money. And of course it is, but you can't keep what you've made if you don't manage risk well. Losses drag down your returns in a very big way. So let me give you an example. Let's say you have $100 in your portfolio. And let's say it goes up 50%. So now, of course, it's worth $150. But now let's say it goes down 50%. Now you're down to $75. So you are far below the $100 break-even mark, right? And this is what people forget. You always make money from the lower number, $100, but you lose money from the higher number, $150. So plus 50% and minus 50% don't cancel each other out. That's how people are used to thinking, but this is the biggest mistake. Now, let me give you an example, which I just gave you of you need to make twice as many returns. When you lose 50%, you need to go up 100% to make up for the difference, right? You're down from $100 to $50 to go back to 100. You don't need to make 50%. You need to make 100%. Now, it's really hard to come up with 100% winning ideas. Let me tell you, I'm a stock picker. I know how hard it is. Money does not just like come about on the streets there. But let's say you are lucky or at least very brilliant and you came upon this 100% winning idea and you now put it to work. Well, all you've done is get back to break even, right? Because you've lost 50% in the first place. Imagine if you'd only lost 20%. Now that $100 has become $80. Now you put that $80 to work in your winning idea of 100%, you are at $160. So it's not the winning idea that made the difference to your returns. It's the losses on the losing idea that made the biggest difference to your net returns. And this is why reducing risk, which means not losing money, is a very big deal when it comes to enhancing returns. And that's why this paradox is something that we have filed away and I've implemented throughout my career, which is why, at Double Duty, the reason why we call it Double Duty is because we think, every investment advisor and manager has a double duty to perform, which is managing risks as well as returns. A lot of people do the latter and they forget about the former and they end up doing neither. We do both. That's the key differentiator. And that's why reducing risk is key to enhancing returns.
Thank you for that. So winning by not losing is something that past investors I've worked with in the value space have said, and you live by. That's actually extremely comforting. It makes a lot of sense. Thank you, Rupal. Going back to, again, your storied career, you have invested through many different cycles over decades. And through those cycles, you have seen many different types of risks, some maybe expected by some investors, the majority of them not expected. Can you, which are always the scariest. Can you talk about some of the risks that you saw throughout these cycles? And importantly, what you have learned about how to manage risk because of all of those experiences?
So, Joan, you're correct. I've now been investing in markets for almost 40 years, which is a long time, 4 decades, and doing this over 50 different countries over that time period and looked at thousands of companies and playbooks. So it, of course, exposes you to a lot and teaches you a lot. I've been through 9/11. I've been through the tech bubble crash. I've been through European sovereign crisis. I went through the Japanese tsunami, the Asian crash, the GFC, the Thai coup, the Peruvian coup, things that people have heard about and not even heard about. There's a lot that goes on in the world,
Yeah.
inflation, deflation, now, of course, stagflation. And many, many other catastrophes and crises, throughout my career. Of course, it feels like, a bull market and people have made money in investing, but people forget, there are very, very big trials and tribulations, not just triumphs when it comes to investing. And so what I have learned is that the biggest risk is actually not uncertainty. It's certainty that proves wrong. It's what Mark Twain said. It's not what you don't know. It's what you know that ain't so is what really gets you into trouble. And investors seem to underestimate, the hidden risks. And that comes back to bite in the form of big losses. Just think about it. When the Asian crash occurred and markets fell like dominoes, people lost something like 80%, right, during that time. It's not because, things were that wrong or that bad. It's because people expected something totally different and the opposite happened, right? They were so certain that it was an Asian miracle and it turned out to be an Asian mirage. By the way, we in our career, actually identified that and actually hedged, both our currency exposures as well as our equity exposures. We managed them down to a great degree. So we didn't make the losses that other people did, because we know that when people are certain about something and it proves to be wrong, you end up losing your shirt in the process. More recently in the GFC, people thought they were owning AAA paper, right? AAA rated securities, and it turned out to be junk, like the absolute opposite. They have the certainty it was high quality and it turned out to be low quality. That's when you lose a lot of money. Similarly, I think we are in store for a very big reset moment potentially for the US markets, where, for a long time, we thought of US exceptionalism, right? That the US is the best place to invest, and we were certain about it. And then suddenly it's being called into question. So I think risk assessment requires a contrarian mindset, because conventional wisdom fails to capture it. And so I think that's the biggest risk of all. It's not what you don't know, it's what you know that ain't so.
That is a terrifying but very true phrase. Absolutely. So, given all of the experience that you have gained over the past 4 decades of investing, what do you see happening in the next 5 to 10 years in the horizon?
So I'm glad you asked me that question in terms of, almost a decade outlook as opposed to what's going to happen in the next few days, because
Yeah.
I really don't know. The short term is full of luck, randomness, right? Good luck or bad luck. But in the long run, fundamentals tend to prevail. And I think in the next decade, you're going to see a lot of surprises. Now, surprises don't have to be bad or nasty. You actually can take advantage of it. That's how you can score an upset victory. Where everybody's betting one way, and if they are proven wrong and you've bet another way and you're proven right, you actually make a lot of money in the process. And I think that, there is opportunity to make money, but I'm pretty bearish on the outlook for the US markets. And also, by the way, the US bond market, right? Both equity and bond markets can perform poorly simultaneously, which is not what people expect. Remember, people are certain that diversification between, 60-40, right? Equities and fixed income can cushion the blow. But that is not true during stagflationary times. Both tend to do poorly. And we've not experienced stagflation for a long time. This is the 1970s I'm talking about. We've experienced inflation, deflation, and something in between, but not stagflation. And so I'm really calling for a regime change, which means you need to reposition portfolios materially compared to what's worked in the past. And in particular, I have 3 calls that I would make in this context. One is I'm calling for the comeback of value investing in a very big way compared to growth investing. The other big comeback, I think, is going to be for active investing, which is stock picking, as opposed to passive investing, which is simply being long indices and long cheap beta. And the third thing that I'm calling for, I think international markets are poised to do far better than US markets. And again, as you know, most investors' portfolio are positioned quite the opposite. So this is quite a big reset moment. And I think that investors, can do very well if they look ahead instead of looking in the past, rearview mirror. It is no surprise to me at all that Warren Buffett, who I think is the biggest investor of all time, has built up the largest ever cash pile. And I think that's because he's creating dry powder for future opportunity. Again, investors should not worry about regime change. They should just try to be in front of it as opposed to be getting caught off guard by it. So there is opportunity if you know how to look and where to look. That's sort of my call for the next decade. There is money to be made, just not in the usual places that you've made it.
Understood. You mentioned growth investing as your first point there, that you believe that will be being moved away from towards value investing. And you're right. I mean, growth investing is definitely in vogue. It has been for quite a while. Can you just talk about the risks that you see in growth investing and maybe why people should start to think about looking away from growth and taking a recalibration of that strategy?
Sure. Obviously, people know the advantages of growth investing. Clearly, people have benefited from it, especially in the last decade or two, with the Magnificent Seven stocks, etc., and beyond. But I think there are 2 things that are the Achilles heel of growth investing that people tend to overlook. And remember, I told you, it's what you overlook that gets you into the biggest trouble, what you ignore. One of the challenges of growth investing is that you have to look out very much into the future to generate the returns and justify the current valuations. And the further out the returns, the greater the risk that you will not achieve them. They're not in the bag, so to speak. That old saying of a bird in hand is worth more than 2 in the bush. That's what you want to be very careful about when you invest in growth investing, because those birds can fly away and you're left with nothing. So yes, growth investing can be higher return, but it comes with significantly higher risk and people don't appreciate that. And remember, I told you, reducing risk is key to enhancing returns. So now this is why, growth investing is something that you want to be very wary of. Second, I think what people forget and underestimate, growth investing gets a lot of play in terms of free markets, free opportunity, because, it's new entrepreneurship, new ideas, disruption, right? That's how innovation, that's how people characterize it. But the very thing that drives, growth in certain industries and certain opportunities, which is that innovation, which is that newness, disruption, etc., is also the very Achilles heel of that investment opportunity. Because just like those companies were the innovators, at some point they become the disrupted, right? They become the incumbents. And so I think investors underestimate the risk of competition and the risk of obsolescence and the risk of something going wrong in the intermediate to long-term future. I mean, just think about it. Not too long ago, people thought of Boeing as being a growth stock and a blue chip company. And today, that company just about skirted, getting junk rated in the credit markets by issuing some equity, right? General Electric, was widely admired and written up in books, as being built to last and, from good to great and all these paradigms, that we were told. And GE does not exist today, right? I mean, it had to completely change its business model, change its management, stop its buybacks. The stock had crashed and so on and so forth. So this is sort of the challenge of growth investing, which is you assume a very good future, but the future is full of surprises. And in effect, you're sort of arguing against yourself. The very thing that you're long, which is innovation and disruption, is the very thing that can hurt your growth investment. So, be careful what you wish for is what I would tell you. And on the flip side, the advantage of value investing is that you don't have to buy into a distant future. You don't have to believe in things getting better. You almost only have to believe that things won't get worse. That's a far safer and lower bar, to cross than that higher bar. So I think that's kind of how I think about growth investing and value investing. Value investing in my definition is investing with a margin of safety, whereas growth investing is sort of throwing caution to the winds and hoping for the best to materialize. And if it does not, I think you can really lose a lot of money, and that's sort of the albatross of generating returns.
That makes a lot of sense. Thank you. Speaking of in vogue investments, private equity, private credit, you can't read any recent or probably in the next, so whenever, article in the Financial Times or in Bloomberg or Wall Street Journal without it talking about private equity and private credit. Can you talk about your thoughts on those asset classes and the risks that you see in those asset classes?
Well, one of the things that private equity and private credit have in common is leverage. And that's true of all sorts of private equity and private credit opportunities. And leverage is one of the biggest sources of risk, but it can also be a big source of returns to an equity investor because it functions like a lever. That's why it's called a leverage, right? It amplifies everything. So during the good times, good news becomes great news. But in the bad times, bad news becomes disastrous news. And this is, because both private equity and again, private credit are built on leverage. So they've delivered great returns, right? Because we've been in good times. But I fear that it's going to flip and bad times are ahead for it, which means disaster returns are ahead for it. And this is why I would avoid them till they crash and become out of favor. I mean, they're very much still in vogue, even though people are sort of talking about, concerns and sort of, there are some sort of risks materializing. And it's become sort of headline news in newspapers. When you look at actual decision making by investors, it has not lost its shine yet or its sheen yet. And I think it'll take some time because, people have obviously built up that asset class and it's become in favor. It's taken a long time to come into vogue. It's going to take some time for it to go out of vogue. That's how these things go. They're long cycles. But I think that gives you an opportunity to get out ahead of time. And frankly, I think in the decade ahead, people will call private equity junk equity, and they will call private equity junk bonds because that's what they really are. But people don't think of them that way. They think of them as high yield and high return, whereas actually, they are junk and very high risk.
That's very interesting. Thank you for that. So you, again, have invested all over the world. You were talking about how non-US names are going to most likely perform better over the next 5 to 10 years. How about emerging markets specifically? They are always, or at least historically, attributed to higher risk. But is that really the case? How do you feel about that group of countries?
So first, all investing comes with risk.
Right.
So if
That's
people think
true.
it's only emerging markets, I mean, that's sort of what always surprises me as to why people call out EM or, international markets as having more risk. all investing carries risk with it. You can risk losing your entire principal. It could be a US stock, it could be real estate, it could be anything. So I'm sorry to say, I think the first notion that people need to understand about investing in equity securities is that it comes with risk. The key is not the risk, it's whether you're being paid to take it. And frankly, if you don't know how to assess that, give your money to a professional person to invest, because whoever knows how to do that, of course. And frankly, I find a lot of people don't think about risk, right? So let alone figuring out how to assess it. And this is why I keep going back to this point of risk, because you cannot discuss returns without discussing risk. So yes, emerging markets come with the risk, but so does everything else. I would say that generally speaking, when asset classes are out of favor, and investors are particularly, when asset classes are in favor and investors are very bullish, usually you're actually not paid to take risk. But the flip side is also true, and that's sort of very true of emerging markets. They've been out of favor. In fact, I would call deeply out of favor for almost a decade plus now. And investors are not only bearish, that means they're very underweight. They expect a lot of bad news to occur, which is great news for, contrarian investors like me and value investors like me, because when the bad news is expected, I'm not saying it won't materialize, it may, but the fact is, when it's expected, it's also in the price, which means you're paid to take the risk of something going wrong, which means that even if it does go wrong, you don't end up losing too much money because it's already in the price. But if things do go right, and that's not in the price, you can end up making money. So I love the asymmetry of that trade. You make money if things go right, but you don't lose too much if it does not turn out to be the case. This is the paradigm of, tails I win a lot, heads I don't lose much. I love that. So I think emerging markets, they are set up for that. And so I'm actually quite bullish. But I want to give you another reason why I'm bullish on emerging markets. It's not just to do with the fact that it's out of favor. There are actually more things in emerging markets that are out of favor too, and that comes with the opportunity. But there's a distinct opportunity in EM, which is not in the price. And I think, again, this is how, we tend to have, our investment thinking tends to be quite unconventional. And we think outside the box, because that's when you have the ability to make a lot of money, because the delta between your view and the market's view, when it's very non-mainstream, when it's very out of consensus, there's a lot of money to be had, right, in that meat of that trade. So one thing that I believe is very misunderstood and not in the price is how emerging markets are a very big beneficiary of a post-COVID world. Now, John, you might have a double take, right? What do I mean?
That's why I don't invest money for anyone, because I'm not qualified to invest in emerging markets. So
okay, so let me unpack that argument. So one of the things that happened post-COVID, right? The big shift, the big inflection point is remote working, right? We all learned how to work from a different place in the office. And remote working accelerated the move to the cloud, where so much of our stuff happens digitally as opposed to physically. So now, if you can be based in Kansas City, to do the work as opposed to New York, that work can also be done in Calcutta. It can be done in, Curacao, right? I mean, it can be done anywhere in the world. And I think because of that, one of the things that has always prevented emerging markets and people living in emerging markets from getting developed markets, work or jobs or opportunity is the visa, right? You need to actually migrate to get that opportunity. Well, now you can stay in your home country and do that work remotely. And India has actually shown the way how the IT industry, can be offshored, right? That was the first astounding example of how the service industry can move offshore. Before that, it was always a manufacturing sector. So we've had sort of a couple of decades of blue collar work being offshored. And we've seen examples of that in manufacturing. China, of course, comes to mind, but that's happened throughout the world, right? Mexico, many emerging markets benefited from that low cost offshoring. People are not thinking about that same parallel, that analogy in white collar work now being outsourced, because in a post-COVID world, things are digital and you can actually outsource your paralegal work, your accounting work, your clerical work, your graphics design. Think about like a lot more things than just sort of your pure IT work. And I think that's sort of the big inflection point for emerging markets. Now, imagine, when I came to this country, America, as a first generation immigrant, I came here because I wanted that opportunity, right? And I had to leave my country, my cuisine, my culture, my colleagues, my community, my currency, a long list of things that I had to leave behind beyond my country, to get this, well-paying and opportunity on Wall Street. Today, that opportunity can go to the emerging market, to that person there, as opposed to the person coming to the developed market, right? And there's a labor shortage in developed markets. So there is work that needs to get done that you don't find the people for. And I think this is going to be a huge opportunity. It's going to take some time, just like the offshoring of the blue collar workforce took time. It takes decades, but that's the opportunity. Now, the good news is, emerging markets used to face this brain drain, and also a wealth drain, right? Because the money that that person is making is being made in the country that they've migrated to, America, Europe, wherever it was. And now that money can remain in that country because you're making that income in that country, you're getting paid in that country, the government can collect taxes, you will spend money in that country, the government will be able to invest those taxes, in infrastructure. I mean, this has become the flywheel of India. So we've actually got a proof point already. Imagine that getting replicated to so many other parts of the world. Now, I know people will say, well, not quite, there. Always, right? There's always the naysayers. There's always, because it's such an early development, it's such a formative stage that it's not real, that it's not sort of tangible. But I think this is exactly the way, change occurs in the world. It first occurs slowly and then it occurs quickly. But if you can identify it, there's a lot of money to be made. So that's the real reason I'm bullish on emerging markets, because I think that people are underestimating, the ability of a lot of people who are educated. There is more high-speed internet. There is electricity in those countries. I mean, those are some of the prerequisites, to work from home, as we all have discovered, right? We need all those things. I think that's going to be a reality. Now, not every emerging market will benefit, but I think, countries like Latin America, which generally have had very poor infrastructure, which means if you're in some remote area, if you're in some small town, you really can't access, big town opportunities, right? The same is true of many, many emerging markets. But in Brazil, you're finding internet being put into place, fiber optic networks at a very high pace. So now you don't need, infrastructure is no longer a bottleneck, to perform a high-paying job. So I think this is going to be, again, a slow but steady sort of improvement and opportunity set for emerging markets. And of course, not every country will benefit, but that's where you have to do your research and homework. But I wanted to give you a very non-consensus, but hopefully very realistic and pragmatic, investment opportunity that people can avail of.
Rupal, it's always astounding to hear how your brain works, or at least get a snippet of it. That is incredibly interesting. And staying on how your brain works, what other opportunities are you seeing right now across the world that you're thinking about for your own portfolio?
So, I think, again, it's this whole notion of, what are people overlooked, right? The obvious that people are overlooking. One of the things that people forget about investing in equities is that the total return tends to come from two sources over time. One is capital appreciation, but the other is dividends. And because so much of the increase in stock prices has occurred in the last couple of decades, where people have made money, it has come through capital appreciation. People have forgotten that in the 200-year history, when people quote that 8% return, total return that investors have made, they forget that almost half of it has actually come from dividends. Not of late, but in the long run history, dividends have played a very important role in total returns. And today, dividends are being overlooked as an investment opportunity. I think capital appreciation will actually potentially be even a source of capital depreciation. I'm actually calling for a lost decade in certain very expensive markets like the US. So you can actually lose money on the index, but you can make money from dividends. And by the way, if you do that, you can still deliver, total returns, which are in positive territory. After all, we want our capital to grow, not to depreciate. So I think dividend investing is something that I would call out. The good news, especially for high net worth investors, many of whom perhaps are in your audience, is that there is a huge tax advantage, that most governments have given, particularly the US, to dividend investing, which is they are taxed at the low rate of capital gains, 20, 24%, depending upon the bracket that you're in, of course, even a single digit number. If you're lower, even 0%, if you're in the lower tax bracket ranges compared to ordinary income tax. So a lot of people, tend to want to invest in bonds, for fixed income. Obviously, I understand that it's a legitimate reason, but I mentioned that if we have stagflation, even bonds can do poorly, right? And the interest income is not tax advantaged. Imagine if you can have your cake and eat it too, you can get the income from dividends, but you can also get potential capital appreciation in the long run if you buy things that are undervalued. I think that you can do that. And I think that's the biggest opportunity ahead of us, is thinking about dividends as being the source of total return rather than, CapApp. And in particular, dividend paying companies tend to be in international markets. US companies tend not to pay much in dividends, plus they're very expensive. The yield on stocks is quite low. So that sort of naturally brings me to where I'm finding value is overseas. And overseas, both in developed markets like Europe, where you have a lot of companies, who are very established, and because they generate a lot of cash flows and they pay it out as dividends, which is obviously not to be taken for granted. Sometimes you can have governance issues. But that's not the case, in many of the companies we tend to find. So I would say that, this is sort of where I'm finding a lot of value, is in high dividend yielding investments, which happen to be international and which also happen to be in emerging markets. So again, I can have multiple ways to win in the opportunities that I mentioned. I talked about the EM opportunity of offshoring, and then I talked about, the dividend opportunity as well. But there's a third source of return that can potentially come from international investing that I think people are overlooking, and that's from the currency. The US dollar, in my opinion, is quite overvalued. And I think that international currencies, including in emerging markets, which I know have been a source of risk, but from time to time, they can become a source of return when a lot of the bad news is priced in. A lot of international currencies, in particular emerging market currencies, are quite undervalued. And so as a US dollar investor, you can get, again, that's third source of return, which is not always a source of return. It can be a source of risk, but I think that it's going to be a source of return in the coming years. By the way, that trend has already started to play out in 2025. You've seen that international markets have done quite well vis-a-vis US markets. International currencies like the euro are performing quite well against all expectations, right? It's not like Europe has suddenly discovered growth, or it has suddenly discovered, a change to its demographics and all the sort of long run challenges that Europe faces. And despite, all those headwinds and negativity, it has performed. That just goes to show you, as I told you about value investing, you don't need a lot of good news to happen. You just need the bad news to stop or not materialize, in full force. And so that's kind of, where we are finding opportunity in markets.
Interesting. Thank you, Rupal. Now I know I'm going to get a lot of questions after this webinar on how people can work with you as an investor, just even getting this little tiny window into how you think and how you invest. To head some of those questions off, can you please just tell us a little more about your firm, how you invest, and your portfolio right now?
Sure, Joan. Well, first and foremost, we are here to serve, not to sell. So
of course, no, absolutely. I'm just yes.
We want to make
investors
can make up their own minds, but what we have an offer is pretty much, we invest, as I've been talking about it throughout throughout this webinar, which is we invest, based on assessing risk, not just returns. So we are always mindful of, does the investment opportunity have that asymmetry? Not only does it have the upside, but it also has limited downside, which means sometimes we leave money on the table. We're not greedy. We don't get carried away. We actually are willing and willing to just stay calm and sit it out till the fat pitch presents itself. Again, that's very important. Patience to me is not the slow move, but the smart move. So if people are philosophically aligned with the way we think about investing, which is we may not make as much on the upside, but we won't lose as much on the downside, and net we'll actually compound at a better rate. That's the kind of investor who would find our strategies to be particularly useful to their, again, needs. I would say that our strategies, all of them, have this underpinning, right, of this philosophical approach that I've talked about. We have strategies ranging from investing in the US markets, all cap, but also investing in international developed markets and international emerging markets, in small caps as well as all caps. Investors can choose. If they want to find out more, they can get in touch with us directly, of course, by just emailing us on contact us at wtmm.com. But what I would call out is that one of the common denominators of many of these strategies is we have deliberately positioned them to have a high quality, which is very important to us because high quality means low risk. And I told you we always want to solve for low risk. But we want to make sure we don't overpay for that high quality, right? So we want to access that high quality at a low multiple. I call our approach to investing sort of the Costco of investing, right? You can count on Costco to give you that high quality at a low price. That's kind of what we want to do in our portfolios. We want to build them that way. So that's sort of across the strategies. But I would tell you that the high, and all of them therefore have a high dividend yield, generally speaking, of roughly, the international strategies, the emerging market strategies I mentioned, the global about, 5+% dividend yields, which is far higher than the, 10-year bond rates, even in the US markets, as about 4.25%. But the global dividend yielding strategy is the highest yielding of them all at about 5.8%, which I think is particularly compelling. So again, I don't want to pick a favorite child, but if you force me to, in the global strategy, we can sort of roam unconstrained. We can go international, we can go emerging markets, wherever the opportunity is. And I would say that's the one that, a lot of our investors are finding it especially helpful because of the tax advantage that I mentioned.
Right.
Also, the level itself is a pretty compelling return to have. So that's kind of what I would say in terms of, how we manage money, our approach to investing. And I think but it may be beneficial for your audience to know that I literally wrote the book on non-consensus
Yes, I was going to mention
investing.
that. Yes, please tell us more.
So-
I've had the honor of reading it, and I have a signed copy from you. And please, it is a wonderful book. So please tell us more.
Well, I wrote it, in 2019. Well, much before that, of course, but it was published in 2019. So it's been 5 years already out there. So, I'm a big believer. A book, should impart classic wisdom and classic investment principles. And I think because it's a very non-consensus way of thinking, if people liked my way of thinking and some of the unconventional kind of investment ideas and, how we get to them, then that book, will give them even a more fulsome picture. This is not me trying to put a plug for my book. It's simply because I believe in education, financial literacy, helping people think through concepts like risk, concepts like passive investing, which again has become very popular, and I have nothing against it. But, whenever people talk about the upside of something, my brain is always wired to also think about the downside of that approach. Active investing also has a downside to its approach. I'm not going to sort of say, but to think about it in a very balanced way, that's kind of why I think, the book makes for a worthy read, because it challenges that conventional wisdom. It exposes you to the things that people have not thought about or fail to think about or think about in the correct way. And so that I think would be very helpful. And, if there is a philosophical alignment, then people can approach us, because obviously we would manage money that way, right? So to me, it's not just about performance, which again, we of course have a track record. We manage money for decades and we can share it, appropriately. But I would just say that if there is a philosophical alignment, if our values align, then it makes for a good experience and a good partnership. And I look forward to hearing from anybody who thinks that, we are the right fit for them.
Absolutely. And again, that I learned so much when I read the book, and just the way that it forces you to look at things in a way that you never thought of. And it was just a very fascinating read. And I just learned so much from it. So thank you for that book. It really moved me. So, Rupal, anything else that you would like to add before we wrap up today?
I think one of the things that people often tell me, and it's almost, like a negative, that, we have to be very patient when it comes to value investing. And we have to be very patient when it comes to managing risks, because, risks are not something that you see till it's too late. right? And it always acts as a drag on returns till it becomes a source of returns. So oftentimes people think that patience is a problematic thing. Of course, human behavior as well, patience is very hard. I would like to reframe the notion of patience as not the slow move, but the smart move.
Right.
Because you can be the world's best trader of trading seeds, but if you let that seed blossom into a flower, you will make way more money, way more. So time is your friend. It does not have to be the enemy, provided you've bought the right kind of business, provided you write the right kind of quality business, because time is a friend of a good business, but the enemy of a bad one. So I would say that people should rethink patience as not the slow move, but the smart move. It's the only free lunch in markets having a long time horizon. The other thing I would point out is, think about if you judge performance or if you judge the payoff of an investment strategy in a very short interval, like a quarter or a year, it's sort of akin to, eating junk food when you're hungry. Junk food is made very quickly, right? Speed is its advantage. If you judge fine dining, which takes time to prepare, right? Gourmet dining, and if you try to eat it within the first 5 minutes of its preparation, it's going to taste horrible because it's not made.
Yeah.
Junk food will win over every single time, over fine dining. But we all know that fine dining is good for you. It satiates you more. It's the right approach, but you need to have patience, right? But when you think about patience in the context of you're going to look forward to a very good experience, then, while you wait for your food, patience becomes positive anticipation rather than something negative. And I think that's how I want people to think about value investing. It pays off in the long run. In the short run, it can disappoint. But, it's something that you have to have positive anticipation around. In the long run, the Warren Buffett approach to investing, that intrinsic value, making sure that you don't get carried away, being patient, thoughtful about risk, waiting for the fat pitch. Those are all classic investment principles that are not dead. They're just dormant. So be patient. They're due for a big comeback. That's what I would leave you with.
I love to hear that. As you know, value investing is very close to my heart, and you are truly one of the best of the best. So I'm thrilled to hear you say that value is making a comeback soon, and you are definitely one of the people to stick with when that is the case. So Rupal, thank you so much for this conversation today. I know that our investors will all benefit from your words of wisdom, and I look forward to following up on this conversation down the road so we can see what things are happening and what we should expect, 5 to 20 to 30 years from now. So again, thank you. And I wish you very well.
Sure, Joan. This has been a very enjoyable conversation.
Wonderful.
So thank you for the opportunity, and I hope your investors and your clients benefit from this educational session. Thank you.
Thank you so much. Thank you.